Hello everyone, welcome back to the channel. I am Margo Nguyen. Alphabet just overpassed Apple's market cap for the first time since 2019. Alphabet's market cap closed at $3.88 trillion on Wednesday, while Apple's remained at $3.84 trillion. This is because the different directions in Alphabet and Apple are heading in terms of artificial intelligence or AI. And since Google's Gemini model has had such great reviews and so many new users are using Gemini, Apple is losing in the AI race compared to Alphabet. And since OpenAI with ChatGPT has also been kicked out of the competition, mostly by Google's Gemini, Google has been growing a lot in terms of its AI agent. Today, I want to talk about my investment thesis for the following 4 companies: Meta, Nvidia, Palantir, and Shopify. So let's get into it. Meta is a company that owns a lot of the social media platforms that we use today. That includes Facebook, Instagram, WhatsApp, and even Messenger. It is an advertising monopoly. The advertising is the biggest source of revenue for Meta, almost 98% of the total. The other part consists of Reality Labs, where the VR headsets and the AR glasses are generating more than $400 million in the third quarter of 2025. Meta is also investing a lot in AI, and it's expected to make more free cash flow in the near term, but it supports long-term AI ambitions. Meta's primary revenue source is making targeted digital ads across all of its social media platforms. And since it uses user data and it has data-driven targeting, they use detailed user data to show very relevant ads. And since it's tailored towards specific audiences, it increases the effectiveness for advertisers. And since advertisers have to bid for ad space, that means that with higher bids, it means better ad performance. This means that Meta is transforming advertising and owning the entire advertising business. If you look at Facebook, if you look at Instagram, if you look even at Messenger or WhatsApp, you'll see a lot of ads. All of these platforms are owned by Meta. It basically owns advertising. Let's look at the company fundamentals for Meta. Meta has its earnings per shares of around $7.25 for the third quarter of 2025. And this has beat a lot of analyst expectations. Analysts have a positive outlook for Meta's earnings, and since that the company has shown very strong historical EPS growth, this is the data that is suggesting future growth and a lot of profitability despite the high capex for AI. There has been one incident where Meta has been hit with a $15 or $16 billion tax charge in 2025, and it's caused by the One Big Beautiful Bill Act. This means that in the EPS, as you can notice, there is a significant drop in the third quarter of 2025. But this is only a one-time event, and Meta expected lower future taxes from the new law. Speaking of revenue, the company has been growing in revenue and growing in free cash flow despite the high capex in AI. And this means that the company's revenue is still showing upward trajectory, and it's going to be increasing substantially in income thanks to efficient operations and cost management strategies. Wall Street analysts have a very positive review of Meta, and it's mostly moderate buy or strong buy. The vast majority of analysis covering Meta recommend buying the stock. And since a very small percentage, because there's a hold rating and no sell recommendations. The company has been doing well in terms of stock price, but there has been a lot of fluctuations based on its high spending on AI. But there is a lot of upside for this company because it has very strong cash flow. It has very strong net income growth, and the stock performance has been increasing so much over the years. Next up, we have Nvidia. Nvidia, everybody knows at this point, it is a company that makes computer chips, it makes AI chips, and it makes infrastructure for AI. Most of its money comes from selling these chips to a lot of tech companies. Nvidia supplies its chips for major companies like Microsoft, Google, Amazon, Meta, OpenAI, and even ByteDance and Tencent in China. They also supply it to automakers like Mercedes-Benz and also governments. This enables AI data centers, robotics, and a lot of other strategic partnerships with TSMC, with ASML, and these are all contributing to our AI growth in today's world. Let's talk about the fundamentals of NVIDIA. NVIDIA has had huge growth over the several years, and this recent performance is thanks to the increasing demand for AI, and that every company is racing for AI. Every company is trying to make a better model. NVIDIA is the company that supplies these chips for these companies. Its revenue has increased substantially. It has almost been doubling every single year. This is because a significant shift in market dynamics and its dominant position in the AI semiconductor space. Wall Street analyst has a positive outlook for NVIDIA, and a strong buy consensus rating is still popular. And since a lot of analysts recommend buying and holding the stock, very few suggest selling. The PE ratio of 63 suggests that investors have a lot of expectations for this company. However, my take on this is that NVIDIA is more like a cult, and it's filled with investors because its growth has splurged so much in the last few years. I feel like this company's stock has been going up because of a trend, and it's not a sustainable growth. Google is now making its own chips. Amazon is also investing in its own chips, and even Meta is trying to manufacture these chips for themselves so that they don't have to rely on NVIDIA. NVIDIA does not have moat over this market anymore. And it has been growing almost 100%, 200% every year. But I suggest a hold if you have this, and I would suggest a very cautious buy if you don't have this stock in the next 2026 year. Next up, we have Palantir. Palantir makes money by selling complex data analytics software platforms, and it's selling them to government agencies and also commercial companies. It's mostly used for defense, intelligence, even law enforcement. I will now attempt to explain what Palantir sells. So imagine if you built a really cool app and now everybody wants it. But here's the catch. One customer wants it on AWS, another one wants it on Azure, and now there's a government agency that says it has to be run on a top secret server. So you would have to try to accommodate these needs by manually updating and fixing your app in 10 different places. But Palantir makes Apollo, and that is like an autopilot feature for your app. Next up, we have Palantir Gotham. Imagine if you're trying to solve a mystery, and you have a bunch of evidences, but they're all in different places. So Palantir Gotham combines all the messy, disconnected data into one giant map that shows you how everything is connected. And last but not least, the product named Foundry is the ultimate operating system for a business. It does everything from logistics to management. Hospitals use it to manage beds. Car companies use it to build EVs, and even banks use it to stop fraud. The US government is working closely with Palantir and will be working with them in the future to modernize its current military technology. So a lot of potential upside to this company, even though it has been increasing for way too long and way too quickly. The fundamentals for Palantir suggest that it has very strong growth. It has a strong EPS growth, and it's beating expectations every single time. There is also a consistent growth in revenue, and it's thanks to the expansion of commercial businesses and also AI platforms. Its most important factor is the strong government contracts that it has. The company has maintained and expanded its government business in the US and allied nations, and it's making a lot of money by these contracts. And it's making its sales more scalable and more efficient. And also, since everyone is trying to modernize their own military technology, there is a lot of potential contracts for Palantir. A lot of investors have a hold rating for Palantir. And I agree with this because it has been trading at a very high valuation for a while now. And since its growing so fast, many analysts are considering that it is overvalued compared to the market and its competitors. The consensus hold is because that even though it has strong fundamentals and growth prospects, it has such a high valuation that many people are showing concerns about the decline and are suggesting to hold. My take on this company is that even though it's a cornerstone of the AI trade, and there's a lot of government contracts and other commercial contracts to come for Palantir, I would also suggest a hold if you have Palantir. And if you don't, I would consider this a not buy. Full transparency, I bought this stock at around $130. So I've had a substantial amount of gain already, and I'm currently holding the stock. I would recommend a hold if you already have a few shares, and I do not recommend buying or buying very cautiously. There is potential for upside as they're scoring more contracts with the US military, specifically the US Navy. So proceed with caution, because I will be holding onto my shares and will be waiting for more news on the stock. Next up, we have Shopify. Shopify is a platform where businesses can use tools to build, to manage, and even to scale their online stores. And they can use Shopify to sell products across a bunch of channels, online, in person, or even social media. And since it has a lot of features like customizable themes and even payment processing, they can even manage inventory. They can use marketing tools. It is accessible for everyone, from solo entrepreneurs to large global enterprises. Its most significant source of revenue comes from subscriptions, because merchants pay monthly or annual fees for the platform. And depending on what features they want or they need, they would choose which kind of plan they want. And since they're using the platform to sell products, Shopify can take payments and transaction fees. They can even take shipping fees, and also they can charge premium apps and extensions that merchants can use to add functionality. A business can use Shopify as an all-in-one platform to manage their online store, and they can even handle the technical side so that owners of the businesses can focus on selling products, manage inventory, process payments, and even marketing without needing to code. A company on Shopify can create their store and design their website, can manage their products and manage their inventory, can sell across a lot of channels, especially on social media. And now since Shopify accepts payments like Shopify Payments, PayPal, and a lot of other stuff, it can manage expenses and it can charge these businesses a lot if they use these services. The fundamentals for Shopify is a little concerning, but my thesis for this is that during the early years, Shopify has had a strategic investment phase. This is where it has reported net losses as it focused on growth and expanding its platform. Shopify's EPS has been very volatile because of its high growth strategy. It is really sensitive to the consumer discretionary economic cycle. And there has been a lot of one-time events such as asset sales and even investment write-downs that has made this EPS go up and down, and it has been missing a few expectations. Shopify's revenue has been steadily increasing over the years, and its free cash flow is somewhat concerning if you look at the graph. But this is because of its strategic repositioning. This is because Shopify is still focused on growing its platform and not taking profit yet. They're always investing their profit back into the company. And now since Shopify has been seeing strong growth in international markets, it has been expanding to Europe and even Asia Pacific. This means that its revenue stream is more diversified, and now it's mitigating regional risk. There's been Shopify Plus plans, and this has been used by large enterprise clients. It means that a more diverse merchant base is now contributing a higher quality and even better revenue for Shopify. Analyst rating has been a moderate buy, and a few of them being strong buys. This is because of its strong business momentum, strategic focus, and even a lot of growth opportunities. But a lot of caution has also been advised due to its valuation concerns. A lot of analysts believe that the stock's valuation is very stretched, and because since it has a very high PE ratio compared to its peers, people are suggesting more on the hold side. However, my speculation for Shopify's future performance is driven by a lot more factors. Its e-commerce market trends continue to grow. Its platform is the best platform to use for merchants looking to sell brand products online. Their platform enhancements has been attracting more and more merchants, and it's increasing their average revenue per user. Consumer spending, inflation, even interest can significantly influence retail and tech stocks. But since that this Shopify stock has been poised and very well positioned for future growth, I believe that there is a lot of upside for this company. Thank you so much for watching this video. In the next video, due to very popular demand, I'll be going over more like a personal finance video. I'm going to show you how to start investing in 2026. I'm going to talk about savings accounts. I'm going to talk about the S&P 500, which is everything you need to know to build your portfolio for 2026 and beyond. Once again, thank you so much for watching, and I'll see you in the next video.